Today we dive into the tumultuous world of Chinese stocks as they face intense pressure amidst seemingly positive indicators. Despite a robust government bond auction and China's assurance of stability through progress, the market remains turbulent. Join us as we dissect the complexities, analyze market trends, and explore the intricate global economic landscape affecting these stocks. China's gross domestic product has been a pivotal indicator of the nation's economic health and growth trajectory. However, this crucial metric has undergone significant volatility, particularly evident during the tumultuous periods of the pandemic. The GDP trajectory reflects a story of resilience, adaptation, and cautious optimism for the world's second-largest economy. Amidst the pandemic's disruptive influence, China's GDP trendline has been the subject of scrutiny. Hovering around 4.9%, the current figures fall just short of the 5% mark. This 5% threshold, observed as a ceiling during 2019 and 2020, represents a critical benchmark for Chinese economic growth. The gradual slowdown leading up to this point mirrored the global economic climate affected by pandemic-induced uncertainties and restrictive measures. Analyzing this trajectory deeper, one can trace the fluctuations in China's GDP back to the early 90s. Over this period, the GDP chart reflects a journey marked by peaks and troughs, each phase shaped by both internal policy decisions and external economic forces. However, despite the volatility, China has consistently maintained an impressive growth rate, even if the recent figures indicate a slowing down from previous robust growth periods. The pandemic, a defining global event, cast a significant shadow over China's economic landscape. The GDP chart visibly illustrates the profound impact of the pandemic shockwaves. The economic slowdown and subsequent efforts to revive growth pose a delicate balancing act for the Chinese government. Striving to navigate the aftermath of the pandemic while avoiding overstimulation in the economy, authorities face the challenge of charting a sustainable growth trajectory. As the nation attempts to emerge from the pandemic's shadow, economic rival efforts have become paramount. The Chinese government's delicate balancing act involves stimulating growth without tipping the scales towards inflation or asset bubbles. This challenge, compounded by a property market slowdown, adds complexity to an already intricate economic puzzle. The official GDP target in China serves as a crucial benchmark guiding the nation's economic policies and growth strategies. While not yet officially set during the recent meeting, indications strongly suggest that the Chinese government is eyeing a target around 5% for its gross domestic product. Historically, the setting of the official GDP target represents a cornerstone moment in China's economic planning. This target acts as a focal point for policymakers, signaling the desired growth rate and serving as a guiding principle for various economic initiatives, fiscal policies, and developmental strategies. The significance of this target goes beyond mere numbers. It serves as a barometer for the health and stability of China's economy, both domestically and in the global arena. Achieving this target not only signifies economic prosperity, but also symbolizes the government's ability to navigate complexities, foster sustainable growth, and maintain stability. The absence of an officially set GDP target at the recent meeting does not imply a lack of clarity or direction. Instead, it hints at a meticulous process wherein policymakers deliberate over various economic indicators, internal dynamics, and global influences before finalizing a target that aligns with the nation's economic aspirations. The expectation and indications surrounding the 5% target stem from the government's efforts to strike a balance in navigating post-pandemic recovery. This potential target is carefully calibrated to stimulate growth, revitalize the economy, and propel the nation forward without falling into the trap of overstimulation, inflationary pressures, or market imbalances. Moreover, the gradual nature of this information release suggests a strategic approach, allowing for flexibility in adjusting policies to adapt to evolving economic conditions. This deliberate process showcases the government's prudence in economic planning and its commitment to fostering sustainable growth in a changing global landscape. Ultimately, the anticipated official GDP target of around 5% embodies the aspirations of China's economic resurgence post-pandemic. It represents a milestone signaling the government's vision for fostering stability, sustaining growth, and charting a course towards a prosperous economic future. The comparison of yield curves between the United States and China provides a fascinating insight into the differing dynamics of these two major economies' bond markets. The US yield curve has been a subject of attention due to its inversion for about a year and a half. This inversion occurs when shorter-term interest rates yield higher returns compared to longer-term rates. Traditionally, an inverted yield curve signals economic concerns, often predicting economic downturns or recessions. Contrarily, China's sovereign yield curve exhibits a different pattern. Unlike the US, China's yield curve shows an almost normal upward slope trajectory. This upward slope typically characterizes a healthier market condition, where longer-term investments yield higher returns compared to short-term ones. The contrast between these two yield curves highlights the distinctive market environments and economic factors influencing these nations. The US's inverted yield curve reflects concerns about future economic growth, potentially signaling a cautious outlook among investors. Conversely, China's more typical upward-sloping yield curve suggests a comparatively optimistic view of the future economy. This curve implies that investors are more confident about long-term prospects, displaying faith in the country's economic stability and growth potential. Analyzing these yield curves unveils contrast investor sentiments and market perceptions. While the US market grapples with uncertainties and cautiousness about future economic growth, China's curve hints at a more optimistic outlook, reflecting confidence in the country's economic trajectory. The divergence in these yield curve shapes signifies the unique economic landscapes and policy directions pursued by the two nations. Understanding these disparities is crucial for investors and policymakers alike, providing valuable insights into the prevailing economic sentiments and shaping investment strategies amid global market fluctuations. The current stock performance in both the Chinese and US markets reflects a divergence in trends and investor sentiment. Chinese stocks are experiencing a mixed scenario, displaying varied movements across different companies. Some stocks are showing resilience, indicating positive gains as they trend upwards, while others are encountering downward pressure, resulting in losses. This divergence within the Chinese market suggests a market that is highly nuanced and potentially influenced by specific company-related factors or sectoral dynamics. In contrast, the US market has exhibited a more unified upward trend, especially in tech and disruptive sectors. Companies like Coinbase and Roku have shown notable increases in their stock prices over the past month, indicating a robust performance within the innovative and disruption space. This contrasts sharply with the varied performances seen in Chinese stocks, presenting a clearer picture of a more buoyant US market, especially in specific sectors. The contrasting performances between the two markets showcase the nuanced nature of global financial markets. While the US market seems to be experiencing a general upswing, albeit with sector-specific variations, the Chinese market reflects a more diverse and mixed scenario, with certain stocks showing resilience amidst broader market pressures. These market trends highlight the importance of understanding regional and sectoral dynamics while analyzing stock performances. Investors navigating these markets must consider these nuanced differences to make informed investment decisions tailored to each market's specific conditions and opportunities. The immediate response of the market to overnight news indicates a distinct focus on other global economic events and developments rather than being significantly impacted by the news from China. Today's market seems relatively indifferent to the overnight news. Instead, attention has shifted towards Japan's upcoming interest rate decision. This shift in focus suggests that investors are more attuned to and awaiting developments in other major economies, indicating a broader global economic interdependence that influences market sentiments. The lack of substantial market reaction to the overnight news from China signifies the multifaceted nature of market dynamics. While certain developments may hold significance, other ongoing global events and economic decisions by major economies, like Japan's interest rate decision, can swiftly capture the market's attention and dictate shorter-term investor sentiment. This market response underscores the interconnectedness of global economies. Investors and market participants closely monitor not only domestic news but also international developments, showcasing how decisions and events in one major economy can reverberate across global financial markets, often leading to shifts in investor behavior and market dynamics. In conclusion, the intricate tapestry of global financial markets reveals a complex interplay of economic indicators and investor sentiments. The challenges faced by Chinese stocks amidst positive indicators like a robust government bond auction and stability assurances reflected a nuanced market landscape. China's GDP trends, hovering around 4.9%, showcase a story of resilience amid the pandemic's disruptions. The absence of an officially set GDP target, anticipated around 5%, signifies a careful approach to balance growth revival and economic stability. The contrasting yield curve shapes between the US and China highlight differing investor perceptions and economic outlooks. While the US grapples with an inverted yield curve signaling caution, China's upward sloping curve reflects optimism about future economic prospects. Stock performances diverge between the two markets, with the US showing a more unified upward trend, particularly in tech and disruptive sectors, while Chinese stocks portray a varied scenario. Amidst these market complexities, the immediate market response seems influenced by a broader global perspective, shifting attention to other major economies' upcoming decisions, such as Japan's interest rate announcement. This dynamic landscape underscores the intricate nature of global financial interdependencies, emphasizing the need for investors to grasp regional nuances and sectoral disparities for informed decision-making. As markets navigate uncertainties, the interconnectedness of global economies continues to shape investor behavior and market dynamics, steering the course of future economic trajectories. Understanding these complex economic dynamics helps shed light on the challenges faced by global financial markets. The landscape is navigating uncharted waters with inflation concerns and the ongoing efforts to maintain stability. For more in-depth financial updates and insights into the ever-evolving global market landscape, stay tuned to our channel. Subscribe for the latest developments. Leave your comments in the comment section below. Thanks, and until next time, goodbye.